Now, joining me for this conversation, we have Dr. Ifeoma Nwokolos, who's an assistant VP, head of research at Financial Derivatives Company. Great to have you on the show, ma. Good morning.
Good morning, Larry.
Yeah, so we see the World Bank pushing for Nigeria to restore petrol import competition. I guess that's something we've all, tried to move away from with the Dangote Refinery and maybe getting other refineries working at this point. How significant is this recommendation for the downstream oil market? I would think the World Bank will be happy we're refining our own oil.
Well, I would say that this decision, this proposed importation by World Bank is coming at the wrong time, because I know that the petroleum industry is already gaining its foot, and we are going off import dependent and PMS for now. And I want to let us know that the petroleum industry is critical in nature, and we have seen some massive domestic investments. So Nigeria cannot refine locally and also import massively at the same time. So this is it's more or less like a policy contradiction. So we should have protection over our industry. We should have industry protection. So when you give access to importation, you are encouraging dumping. So you see dumping going on in that industry. And once that happens, there are implications. For us, where you have a balanced policy is where the local industry is not producing enough and you want to complement so you can import. But this time, we know that the local industry is producing enough for us to consume. So why are we encouraging importation? And we want investors to come into the refinery, to our petroleum industry. We want them to import. We want them to invest in the petroleum industry. If we want them to invest in the petroleum industry, asking for importation is like discouragement of investment in that particular sector. So I think if the issue is that if they feel there's price exploitation or policy pricing and monopoly pricing, I think that we have consumer price protection agencies. This is the time for them to do their work. But for encourage importation, it has several implications on the industry. If you look at modular refineries, some of our modular refineries can be referred to as sunset industries. So if you encourage importation, which we have already gone past, so you may be trying to kill those sunset modular refineries. And what happened to the infant industries like Dangote Refinery? What happens? You see that investment in that industry is definitely going to die. And very soon we are looking at listing of this industry in the GS. So are we encouraging people to invest or to invest in industries? And let's not forget that once you encourage importation and you are importing, you are creating employment outside and creating unemployment. So we should look inward and know that the unemployment level alone and the squeeze we are facing is enough for us to increase unemployment within. And also it's going to also weaken the industry. Yes, and it will slow Nigerians' industrialization, reduce investment, discourage expansion of the modular refineries. So it means that our modular refineries will remain as sunset industries. So we need to look inward, because it's also going to reduce the multiplier effect that we already have, having these local industries around us, is going to also increase FX demand, because for you to import, you need to source for FX. Further pressure on the naira. Already we have seen our gross external reserve drop from 50 to 48 billion dollars. So it is going to be further pressure on the naira. So I think that the goal should be healthy competition and not import dependency, because this can destroy the very domestic capacity needed for long-term competitiveness. So the essence is to protect our infant industry to do better and not to start encouraging importation. So how sure are you that even if we import, it will not end up in smuggling? Because if you look at the countries around Nigeria, I think we still have the cheapest PMS price and diesel price. And let's not forget that if we have domestic industry during the global shock that we saw oil price go as high as $120 per barrel, I tell you that PMS and diesel price would have hit the roof. We have seen PMS selling for over 2,000 naira per liter. But because we have domestic industry, we didn't really feel this like other countries. So I think this suggestion is not coming at the right time. I don't think it's the right decision right now.
Well, I guess it's a recommendation.
Yes, it's just a recommendation, but I don't think this recommendation is necessary.
All right. So looking at other countries now, we have the likes of, Mexico. They refine and they also import fuel. Brazil, Egypt. I think it's tagged a refining gap at this point. Do you think we have a refining gap? And with the Dangote Refinery currently dominating supply, is it a monopoly or just a transition market?
Well, I would say it's a transition market. I wouldn't call it a monopoly, because we have other modular refineries, which we have been agitating that if they are not functioning, there is need to sell them out for investors. But if we are encouraging importation, I doubt if investors are going to be investing in these modular refineries. If the question is that we are seeing monopoly pricing, that's why I talked about the consumer price index agencies. Other countries are importing. Yes, we're not saying we shouldn't have importation, but not aggressive importation. The way the World Bank is putting it is looking as if we should now depend on importation. No, there will still be importation. But I'm asking, why the importation? Why? Because we have the refineries that are producing more than enough of what we consume. Importation is good. I'm not saying it's not good. It's good, but it shouldn't be an aggressive importation that will harm the domestic industries that we have. So there should still be protection for our local industries. I think that is the goal.
Okay, and let's pivot now. Back to the oil markets. At this point, we had the biggest drop since 2020. That's the biggest single-day drop. That was yesterday. But now we're beginning to see some recovery now, and it almost seems like the de-escalation that we saw yesterday is not what we're seeing today, with oil already rising. Brent 2.63% higher this morning. WTI 3.58%. WTI is still more expensive than Brent at this point by a couple of cents. Is it time to still feel optimistic about de-escalation? With what we're seeing playing out in the oil market today.
Well, Ladi, I would say that what we saw yesterday, what we saw 2 days ago was an abrupt response by Trump. And you know that it's a fragile ceasefire. It's a ceasefire talk. It's not a ceasefire request. So we can refer to it as a truce. So the market is still rising in uncertainty. Coupled with what happened early hours of today or yesterday, we saw that Israel attacked Lebanon. So this is to show that there is tendency that we may have escalation, even though Iran's tried to do what we call a human shield. Yes, before the deadline that Trump gave them, they all shielded their infrastructure. I think that was why we saw that abrupt response by Trump. But that does not mean that the issue has fizzled, because Iran has insisted not to open the Strait of Hormuz. And right now, to speak, the Strait of Hormuz has become a choke point. A choke point in the sense that they are even talking about collecting toll fees of $2 million per tanker that passes through that checkpoint. So if that happens, I think Iran will be sitting pretty. They will be making over $60 billion compared to what they make ordinarily from exportation of their crude oil annually, which is around $40 to $64 billion, depending on the price of oil. So I think that the market is still factoring in uncertainty. That is why you see the oil price went down sharply to $92 per barrel and reversed itself this morning to about $97 per barrel, because the uncertainty is still there. And let's not forget, Trump is already saying that the militants are still very much around and within the Iran. So anything can happen. But are we going to see a massive attack this time? I don't really think we are going to see a massive attack this time, because the truce can be extended after, because US is going to be having their midterm election very soon, probably maybe in June or July. And Israel too have their own saga they are dealing with. So I think this ceasefire talk between the US, and Iran and Israel may be extended. But the market, the fear that there is going to be escalation is still very high. That's why we are seeing oil price hovering around $90 and $97 per barrel.
All right, I guess we have to keep tracking, what's playing out there. Hopefully we get convincing de-escalation at this point. Thank you so much, Dr. Ifeoma Nwokolo, Assistant Vice President, Head of Research, Financial Derivatives Company. Thank you for coming on today.
Thank you for having me, Matthew.